Hi, everyone. I'm Rick Bensignor. Today is Tuesday, April 12th. Welcome to this week's In the Know Trader Show. As we record this late Tuesday morning, the S&P is up about 35 points, 0.8% or so. Qs, which is, of course, the NASDAQ tracking ETF, up 1%, so it is outperforming on the day. US 10-year rates fall 8 bips today, down to 267. We've got crude oil up $6.50, over $100 a barrel. It's a good thing. Yesterday, I was telling clients to buy oil. That worked out nice. Natural gas up another 14 cents and on its highest levels in quite some time. Bitcoin getting back just a couple $100 after getting smushed the last few days, sitting right near 40,000. The dollar is hanging out right near, when I say the dollar, I mean the dollar index. That's right about 100. That's also about the highest levels we've seen on the entire cyclical move higher. Gold's up $30 today. So that's kind of the picture across the markets. As far as today, what are we going to do? Well, in trader education, I will pose the question, how long has it been since you made any type defensive move in the market? We'll talk about the implications of both doing so and not doing so. In our kind of global market overview, we'll take a look at the Dow via the DIA tracking ETF, the TNX for the US 10-year, and we'll take a look at Bitcoin using Bitcoin futures. And then today, I figured, given what's going on in the markets and the amount of movement and shifts in the sectors, let's take a look at the 11 macroeconomic sectors. Those, of course, are the XLB, XLC, et cetera, which are materials, communication services, energy, financials, and so on. So we'll take a look to see what's going on, what looks like still has good charts, and which ones are potentially in trouble. To sign up for my weekly ETF Tactical Trader Report or the 7-Eleven monthly Spider Sector ETF report, go to intheknowtrader.com. So what's the weekly Tactical Trader Report? It goes through the macro view of what's going on. So we'll take a look into the bonds, the dollar, credit spreads, usually gold, deep dive into the S&P for key levels to play off of and to know what's important. Then it gives a new ETF trading idea each week. And it also updates every open position we have in a prior week's ETF recommendation until it's closed out. So we often will trail our stops as we're making money. So we move stops. We rarely move upside targets or downside targets, but we will kind of protect profits we have generally. And that's what that report is. Usually comes out Thursday evenings. The 7-Eleven report is a report designed to beat the performance of the S&P. It uses a universe of the 11 Spider Sector ETFs, the same ones we'll be looking at today, and we'll pick no more than 7 of the 11 to be in at any given time, generally for a full month at a clip. Sometimes it's many months, but once a month we reallocate. And so through March 31st, we are outperforming, or in the month of March, it outperformed by 20 bips relative to what the spiders did. For 2022, this report's outperforming by 1.71%. For our fiscal year, which started August 1st of last summer, it's outperforming the spiders by 2.62%. And for our entire history, which goes back to August 1st of 2020, this is outperforming by over 600 basis points. This is a huge win. And if you've got money in spiders or Qs, consider subscribing to this report because it has proven over time that we can outperform the market. And therefore, you are doing better than simply passively sitting in those ETFs. My email address to reach me, Rick at InTheKnowTrader. Let's also take a look at what's going on in the sectors year to date, because we're seeing some shifts occur in the last few weeks that have been different than we've seen recently. So we've still got, look, the S&P is down 7% or so on the year. And you can clearly see the three sectors right next to where the S&P is on the left-hand side: consumer discretionary, communication services, and tech are badly underperforming. Two of the three of these had been previous winners. The one that was not is communication services. That's been a dog for a while. Clearly on the upside here, joining energy, which just a couple of weeks ago was the only sector to outperform. You've got staples, healthcare, and utilities, and then the rest are underperformers. I'm sorry, they're down on the year, but not as bad. So they're actually outperforming the 7% down move in the S&P. So interesting to always keep an eye on this and to notice that the market has shifted more defensively, because a week or two ago, we only had energy there. And now you're seeing that, utilities, healthcare has crossed over. You are seeing a more defensive posture in the market. And that leads us to today's discussion on kind of how long has it been since you made any type of defensive move. Now, a defensive move can be as simple as simply selling out of a stock that you no longer think is going higher, but it could be much more than that. It could be an actual shift in your positioning in your portfolio. And I recognize that if you're listening to this show, chances are, besides having an investment portfolio, you're also most likely more trading oriented, because we tend to think the in the know trader, certainly the weekly tactical trader report, is just that. It's tactical trading. It is short-term trading. It is not about investing. Whereas the 7-Eleven is more about investing over time in the right sectors at the right time. But let's get this back to this conversation. If you're a trader, you need to be both buying and selling with some frequency. That's what trading is. If you're an investor and you say, hey, this market has done fantastic over, well, let's just say the last dozen years or so, since the great financial crisis ended in March of 2009, and the markets have been on fire since, with a couple of drawdowns along the way, but nothing significant that was lasting. And obviously the S&P and the NASDAQ made, we'll use the spiders and the Qs, made all-time highs, to start this year. So we're off, but we're not off a ton. But the question you still have to ask yourself is, have you made any type defensive moves? Have you lightened up? Have you done anything at all to reduce exposure? And if you haven't, ask yourself the questions, why? Is it because you're 30 years old and a long-term investor, at least in that part of your portfolio, such that you don't care if the market comes off 20%, and perhaps you're not even looking to play or shift your focus and portfolio with a 20% move, because you're young enough that over time, there's probably no better place to be than the stock market for investing. And therefore, with a 20, 30, 40 year time frame or more for your investments, you don't need to be shifting, trying to play the tactical moves that show up over time. You want to be invested for the long haul, and therefore you haven't really made defensive moves. And that kind of can make some sense. But if you're, let's say, 50 years old and listening to this, and it's not that you're close to retirement, but you're closer than if you were a 30-year-old, is anything that you're seeing going on in the marketplace make you second think that the market is just going to continually move higher the way it has in the past? And one of the things that I'll say that should be part of that consideration is, where's the Fed? Because we know that the Fed is generally the biggest influence, and what they're doing with monetary policy is the single biggest influence on the stock market over time. So when there are periods of easing and the money is flowing, they generally indirectly or directly help prop up the stock market. But that's not where the Fed is now. They've made it very clear. They are going into a significant tightening cycle. Inflation is rampant. We had another inflation report today that came out, and we're still up at very, very high levels. And if we know that the Fed is going to be raising interest rates over time, then one cannot assume that the 20 and 30% type returns we've seen over the last couple of years in the market are going to continue. Why? Because simply what let's call it the fuel that has been able to lead the market higher over time is no longer going to be there in the same way. And a hawkish Fed doesn't mean the market can't rally when you have a hawkish Fed, but it's certainly going to influence the degree to which it can rally. And therefore, I think it at least makes sense to be open to the idea of doing some type of defensive moves in your portfolio. So what are some type defensive moves? A, you lighten up on some exposure. You raise cash. That's one thing you can do. Secondly, you can rotate. You can put more money into the sectors that are outperforming, and or at the same time, reduce exposure in those that in this type cycle will probably not do as well as the market itself. So if you take a look at something like technology, higher interest rates generally aren't great for the mega cap names in NASDAQ. And therefore, you can ask yourself, are the QQQs, which most of us have some exposure into, either directly through the ETF or certainly some of the key names in the Qs, are those the names to be in going forward? And again, it doesn't mean they may not make money, but is there a place that you can put those same investments into that are going to generate better returns? And generally, I'd say the answer is yes. The NASDAQ peaked over a year ago when you look at the average NASDAQ stock, not the Qs, which is the top 100 names, the NASDAQ 100. So these are the cream of the crop capitalized names. And those are the ones that led the indexes higher. But your average NASDAQ stock has gotten crushed in the last year, some way beyond 50% of their value. And you have to ask yourself, does it pay to hold on to that? Or is it worth potentially, let's say we're talking about a taxable account. Is this worth reducing exposure and taking even a loss and potentially a decent loss and offsetting it with stocks you have that are decent gains for tax purposes? So sell out of a large winner to offset a large loser. And therefore, you have no or nearly no tax liability on the gain because you've taken a loss against it. And what that does is also give you fresh capital to determine where to put that investment in that can do better than staring at a stock that could take years and years to come back to where you bought it sometime in the last year. So, something to think about. The market is clearly concerned with what are the three biggest headwinds. One right now is the Fed, for sure. Two, inflation. Three, the war with Russia and Ukraine. They all materially affect the stock market. And if you think, well, we're living here in the US and it's a shame what's going on over in the Ukraine, but it's not our problem. When it comes to the markets, it actually has significant effects. You'd be surprised how much industry comes out of the Ukraine that feeds the world, that helps feed the world in the sense of fertilizers, parts, supplies for cars. There's a tremendous amount that actually comes out. And between sanctions on Russia and supply chain issues out of exports out of Ukraine, which are virtually come to zero right now, this is going to affect the ability for companies that are part of that supply chain to produce products and get them on the shelves and get them for you to buy. So their corporate profits are going to be affected. The value of the dollar going as high as it is certainly has an impact on companies that do international transactions. And, certainly if you look at the Fortune 500 or S&P 500, any way you want to look at it, many of them have significant overseas operations. The higher cost of the dollar impacts profits. So there's a lot of macro headwinds that exist right now that really should make you think about being more defensive and certainly not as offensive as you've been in the past. Now, when we look at some of the charts, we'll notice that we've sold down to some levels that are close to support. And yesterday's low actually got fairly close to some key levels, and we are getting a bounce today. And we've been higher than we're trading right now, and we've been lower, of course, over the day now. So we're not quite on the highs of the days, but in the bigger picture, you can make a case to potentially do some buying, but because the market sold off so much. But at the same time, think about where you're buying, what you're putting your money into, and where over the next 6 months to 2 years, as best as, let's say, you can guesstimate what's the best places to put your where to put your money if you're going to stay fully invested in the market. I can tell you, I have used the rally as I've suggested to you. I have lightened up overall exposure. I have more cash now than I've had in a while. I will tactically look to enter ETFs or individual names at right times and places. But am I looking to buy tech now the same way I have in the past? Am I looking to buy consumer discretionary, let's say, in the same way? Well, no, because these things have underperformed. They've gotten clocked, many names, and they're going to have significant overhead resistance, where something like, we'll see here when we look at the charts, something like consumer staples are up on all-time highs. So when we look at the XLP chart, you'll see that. So hopefully the rest of the show, you'll get a sense of some of the places that potentially make sense to put money. So let's start with, not this chart, it just happened to be, but let's move to, so let's take a look at the Dow. And here's a daily chart of the Dow. And the cloud, actually, we're flipping much there. There isn't all that much help here. But of significance is that about 4 days ago, the low of the move came to this dashed purple line. That's the bearish propulsion momentum level. If we properly break beneath that level, then it says there should be enough inertia to the downside to get to its exhaustion level. Well, we held where we needed to, and we're still above it. So in that respect, I would look at the 342 level in the diamonds as being important from a short-term perspective. And as long as we're holding above that, then things are okay still, and the pullback from the recent highs is nothing more than pullback. And if you look here too, if you look at this even as a potential wave pattern, so 1, 2 down here, 3, we're in 4, 5 could easily bring us higher, challenge and even take out the highs we've seen in March, though there's still nothing that makes me think that we're going to plow to new all-time highs. So I've used this rally to lighten up into. But anyway, that's a look at the Dow. Let's take a look at the US 10-year. And here's a weekly chart. So we broke through the 2.5 to 2.62 level. Basically, 2.5 was what I thought the trading target would be from the move up. And we have certainly gone through there. Now, if we look at the trading target from the inverted head and shoulders, that measures to about 3.25%. So the trading target is different than the bigger target over time. Unrelatedly, 3.25% is virtually the last high made before the final drive down to the all-time lows. So 3.25, when and if we get anything near there, should be some decent resistance. But we are seeing a pullback today. And where's support? Well, I'm looking, there's an unfilled gap here just north of 2%. There's a level along the way, which is just about at 2.4%. So I'm also going to watch what happens if we get down to 2.4. That's the propulsion momentum level. That's the bearish one. So will it bounce off of there and actually end up being bullish, or will it properly confirm and move through there, which then targets actually an area into that unfilled gap? So that's kind of how I'm looking at things. But again, don't fight the Fed. The Fed's clear in what they're doing. So whatever pullbacks you see in interest rates, you kind of know that they're still, in the scheme of things, temporary, and that rates are going higher. How do we know that? Well, the Fed has telegraphed it more evidently than basically any Fed has in the past. So therefore, even though rates can pull back, we know that over time rates are going higher. So, you can be the hero who's trying to perfectly pinpoint this high and play that, or you can really look to and shift your portfolio. I've told you since right in here, last summer, I told you I sold out of almost my entire bond portfolio on this move down, and was looking for rates to go higher. And, we timed that perfectly with the weekly 9 count here. And I have my entire bond portfolio is hedged out. So I'm fully prepared for interest rates to go higher. And lastly, let's just take a quick look at Bitcoin before we get to the sector chart. So here's your all-time highs up on top. You notice that the low in January, right in here, filled this gap that had been in place. And then we've basically been in a trading range that broke out to the upside. In my institutional report, where we were long a Bitcoin 40,000, 51,000 call spread, we sold half here and we got knocked out of the other half yesterday. So we only ended up taking out about half of what we could, but we did sell the high of the move on half the trade. And right now, when I take a look at this, the only thing that potentially makes me maybe mildly bullish is that tomorrow, unless we get a really strong rally between now and tomorrow's close, tomorrow will be a setup 9 count. And we can see that often the setup 9 counts give us some short-term trades. But I don't love the fact that we took out the highs here near 45,000, 46,000, shot up into the upper 40s and pulled right back down. That's not particularly good. And these other horizontal lines beneath us are unfilled gaps. There's one down near 25,000 and one under 20,000. I don't see any gaps that are unfilled on the upside since having made all-time highs. So that's not a good sign either, in the sense that markets often come back and fill gaps. All right, let's get to our sectors and kind of get through them. I'm going to start. Let's see, do we have, well, it's on XLK, but what I'm going to do is just switch this to XLB and we'll go through these alphabetically. So materials, getting near all-time highs, most importantly, bounced not only against prior support. So if we look, the support here going back to last summer, we're closer, and it's at least a place as we look through these charts, you'll see this is one of the better charts. So materials, more above the 50% level of just where the price action has been. Still, it's very possible we could be in a trading range. Let's put some weekly Bollinger Bands up. They're fairly flat, but at least one of the better charts. XLC, communication services, totally different looking chart. Came very close to the middle Bollinger Band, and it's backed off. Right now, it's holding on to the clouds conversion line, but clearly this is a place that's having trouble. And one of the weaker sectors, and hard to make a strong case of why this is going to materially move higher. When and if this rally to get to its upper Bollinger Band, if it's still downward sloped, you probably want to kick out of anything you've got in that area. XLE, energy, virtually on all-time highs, still hanging in there nicely. One of the best charts you're going to see. XLF, financials, struggling. Shot a little bit, came a little bit above the middle Bollinger Band, came back down here. We are holding against the top of the cloud. That's the only thing that I really see that's decent here. But it's not one of the better of the sectors. XLI, industrials, kind of looking like financials, beneath the middle Bollinger Band in its cloud. It's okay, but nothing special here. XLK, going to be one of the worst ones, came to the middle Bollinger Band and held. Notice the baseline here on the Friday closes. We gap beneath the conversion line. We're holding the top of the cloud here, but certainly tech has been a difficult play and not a place that you're really making money. Take a look at XLP, made new all-time highs this week. Staples, I said, we've shifted to a defensive market. It's very clear to see that that's a sector that's doing better. Here's REITs, also one of the better ones above its middle Bollinger Band. Hasn't hit its all-time highs, but one of the better ones. XL, what do we have here? XLU Utilities made all-time highs last week, pulled back a little bit this week, clearly one of the better ones. Healthcare, all-time highs last week, does have a 13. It's not confirmed yet, so any subsequent week that the Friday close is less than the Friday close from 4 weeks prior is potentially an issue. Otherwise, this is good. And the last one that we will finish on is, oh, wait, I think we skipped REITs. I'll go back. XLY, one of the weaker ones. Again, you can make the case why it's not one of the ones to be in. And sorry, here's REITs. I don't remember if we looked or not, but above the middle Bollinger Band, one of the better ones. So that's it. Those are the 11 sectors. Hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.